12. We're going to, we always like to start right on time and we end right at 1 p.m. I want to welcome everybody, and people continue to trickle in and come throughout the show. I'm Dale Caldwell, the Executive Director of the Rothman Institute of Innovation and Entrepreneurship, and I'm pleased to be here with Alan Sobel, who's going to be our featured speaker. Our friend Tony Russo, who's on most of our shows. I know he has a couple of questions from the CIA&J membership. But we have a special guest, my boss, the Dean of the Silberman College at Fairleigh Dickinson University Business School, Pierre Baltazar. Pierre, welcome.
Oh, thank you, Dale. And I would like to welcome everybody that's on the Zoom today. I try to make these, I'm a family business guy, and I enjoy a lot of what Dale's been doing with the Rothman Institute, and I'm certainly a big fan. When I saw that Alan was presenting today, I just had to pop in. So, this is not indicating that what was done last week or next week is any more or less important. If I had the time at noon on Fridays, I'd probably show up at all of these. So I'm tickled that you're all here. It should be a very good conversation. I look forward to listening to Alan. And now I'm going to just melt into the background and wish you all a good day. Not too much shoveling, by the way. It's hopefully you stay warm. All right. Bye, folks. Thanks, Dale.
Thank you. Thank you very much. And Pierre has been wonderful in that he is really focused on entrepreneurship, and the Rothman Institute is playing a critical role. And so he's been so supportive of what we do. So Alan, I'm gonna kick it off. We have some new people on the line, and I'm going to talk a little bit about who Rothman is, and then I have my slides, and then we'll jump right into the questions.
Great.
So I hope everyone can see my slides there. Okay. And again, this is the Rothman Institute of Innovation and Entrepreneurship at Fairleigh Dickinson University, the Silberman College of Business. And Alan Sobel, as we said, is our featured guest. And we're really excited, especially this time of year, Alan. This is when everybody's really getting nervous about taxes and what's going on and what's changing. So people are waiting with bated breath. And so I'll go through this real quick. So our mission is to support, promote, and research entrepreneurship with a special focus on family and veteran businesses. We have a Family Business Alliance where we provide a wide range of services from coaching to consulting to programs for family businesses. We have student programs, student competitions that we've had for 30 years. A national program called Veterans Launching Ventures, helping veterans and their immediate family members develop business plans and grow their business. We've done a lot of articles, research, and policy around entrepreneurship and public policy thereof. Strategic planning, we're doing a lot of strategic planning with individual companies. We're focusing more and more on urban businesses. We are now expanding to do certification programs through SHRM and some other institutes to really provide expertise for folks at all levels over and above the entrepreneurship. And so we wouldn't exist without our sponsors. The TD Bank Charitable Foundation has been a long-term sponsor and a friend of the Institute. Provident Bank as well, SunTrust, and the Commerce and Industry Association that Tony chairs. Why are we doing about this thing about entrepreneurship? That we're actually passionate about this because it's more important than ever. It's key to bridging this political divide as this country is divided. It's written some articles about that. Public policy supporting entrepreneurship, and we're supporting the establishment of what I call entrepreneur zones. And I'm chairing a working group looking to develop these that will really help to finance and support entrepreneurship throughout the state of New Jersey. So one of the things that we're very proud of, we started something called Family Business Week, which is the 4th week in October. We're encouraging people to support family businesses every day, but we're really almost like American Express's Shop Small and others. We really wanted to let family businesses have a special place in society. And so we're encouraging you to find out who your family businesses are and your neighborhood and shop them. I do a TV show called Family Business World, and a number of folks I see in the audience, and Tony's been a guest. I wanted to have Alan on the show at some point. We have our Family Business Fridays that we are actually one of the first to start this last March to really have, and Sue Slavin and Maura Panuski on the Rothman team have really done a wonderful job coordinating this. And the response has been wonderful because we have tremendous guests like Alan. Our Veterans Launching Ventures program, this year we had over 50 people sign up for the program from 24 states, really helping veterans develop entrepreneurial businesses and succeed in this new business world, even in the midst of the pandemic. We're very proud of our Rothman Institute of Entrepreneurship YouTube channel, where this video and others will be housed. And so if you miss something or there's somebody you want to see, you can go there, and we want to keep that as an inventory and have a permanent record of really information for folks who can't make it at 12 noon on a Friday, or who want to see my show. And then we're very proud to have our New Jersey Family Business of the Year Awards every October. This October we did it virtually, and I'll embarrass Alan. Alan kicked it off with his that was your grandchild, Alan? Yeah.
Yeah, sorry. Yes, that was my first granddaughter on my lap. Exactly.
What a great way to, and we had Thomas Clark, our video expert, who did that. And that was a wonderful way. You guys look alike. He's gonna, it was a wonderful. If you haven't seen it, it's on our YouTube page, so you should watch our Family Business of the Years. Laura Mashtala from Black Swan Espresso. We started this new category, New Family Business of the Year, because a lot of the other ones have been around for so long, a new business couldn't win. We had our family business under 10 million in sales, and so Dennis Mikula from Mikula Contracting. And the family business over 10 million is Mike Seitel from Norwalt Design. And so we are always taking nominations for family businesses that people know. So we encourage you to support that. And then we've written a number of articles about entrepreneurship, and let's go through this real quick. And so we really believe that it's important to get the message about entrepreneurs, family businesses, small businesses. And so now we have the pleasure of having Alan Sobel, who is a legend and well-known and well-respected and well-liked. So Alan, thank you so much. So why don't I ask you, what's new in the tax world as we start, and we're entering this new administration and new decade?
Well, first of all, Dale, thanks so much for having me here, and it's great to be on screen with you and Tony, two people that I admire tremendously for all the great work that you're doing for entrepreneurs in the state of New Jersey in support of New Jersey business owners. Before I get to your question, I'm not avoiding it. I just want to emphasize that the strength of New Jersey lies in having a vibrant economy, and anything we can do to be supportive of small businesses and entrepreneurs is critical. And so whether it's the Commerce and Industry Association advocating for policies and procedures that really protect businesses, or it's the Rothman Institute that provides these kind of resources to help businesses thrive, it's critical. And as a firm that focuses on family-owned and entrepreneurial businesses, we need all the help we can get in making sure they're successful. Our success is predicated upon them, and it's kind of that cascade effect. So thank you for all that you do, and thank you for allowing me to participate things that are here today. The one thing they always say, the one thing that is certain in life is death and taxes. And I would add one more to that, and that is change in taxes. It just seems like we're always going through changes, and politicians feel the need to constantly be tweaking the tax code, whether it's at the federal level or the state level. And it gets very, very complex and very confusing. It makes it difficult to plan for things. So change is always abound, but the truth of the matter is that the core of taxes pretty much stay the same. And so, it's around the edges that things ultimately change. We had a big tax change in 2017 with the Tax Cut and Jobs Act. That forced a tremendous amount of changes. It was probably one of the most significant pieces of tax legislation that came down the road. And then most recently, we had the Tax Act that was passed at the end of 2020, the Consolidated Appropriations Act, or the CAA, that provided stimulus and things of that nature to people, but also had some tax changes in there. So some of the highlights, depending upon where you're at, and I'm going to talk a little bit about some of the individual side, but I'm going to try to focus a little bit more on the business side of things, because we're here talking to business owners. But on the individual side, first of all, the college tuition deduction, which if you are in the right income side, has been liberalized with a lifetime learning credit. So there's a little bit more of an advantage to that than there was when you had the deduction of the college tuition. That might apply more towards people that are in the moderate to lower income level. It might not apply to business owners that have income over a certain level. There was a reduction in the itemized deduction. So when you deduct medical expenses on itemized deductions, there was a threshold, a floor that you had to come over. They lowered that and permanentized it to 7.5% of your adjusted gross income. So that's a good thing, particularly in the COVID world where people might have incurred more out-of-pocket expenses, or have elderly people that have have more dependent care or assisted living care and things of that nature. There was some.
Let me stop you there. I normally don't say this to everybody. Get a pen and paper. There is so much good stuff here. So if you don't have a pen and paper, I'm stalling so they can get a pen, because you have so much good stuff, man. This is I'm taking notes. So go ahead. Sorry to slow you down.
All right, and by the way, there's a lot of information that's out there as well on this stuff. The beauty of the internet is the amount of information that's available. So if you miss anything, you can certainly go to our website, SobelCoLLC.com. We have a lot of resources on there, as do I know there's a lot of stuff that's written about this stuff. So yes, hopefully everybody got their pen and paper. Hopefully this is not going to be something that's widely applicable. But for those of you that are in a bad place and are receiving debt relief on your personal residences, there is tax-free treatment that's been brought in to ensure that you don't get whipsawed on the forgiveness of debt. So they've lowered the limits on that to be able to have people that are really in difficult situations take advantage of it. For those people that were not able to provide 20% down on your mortgages, when you purchased your home, you had something called PMI, mortgage insurance. There was a phase out that was going to take place that was not going to be deductible as a part of interest. That's now been extended, so you can continue to write off your mortgage insurance as interest expense. This is a good one. This is a good one for both those that receive it, but also for employers. So in the past, if you provided student debt relief to your employees, that was considered taxable income to the employees, akin to giving them wages. So I always say that it's better to receive, depending upon your tax bracket, it's better to receive anywhere from 80 to 60% on the dollar than to receive nothing, meaning that if you get a bonus from somebody, I'd rather pay the tax on that bonus than not to get the bonus in the first place. And that was true for employee debt, student loan debt as well. If an employer had a program where they paid towards your student debt and you had to pick it up as income, it's better to save, round number 70 cents on the dollar by getting the debt debt relief than it was to not have it at all. But here's the beauty: under the CAA Act, the act that was passed at the end of 2020. Employers can give students, I believe it's up to $5,000 in student debt relief, and it will not be included in taxable income. Oh, wow. So it's a great way to give a bonus to your employees without being subject to tax, and it's a wonderful benefit to be able to provide. But again, you have to be inclined to do that in the first place. Dale, one of my truisms is I always say that you never let the tax tail wag the economic dog. So you first have to be inclined to want to do that. And then there's some tax advantages to doing it because the employer gets a tax deduction and the employee does not have to include it in income. So since we're at a college forum here, I thought that would be one that would be of interest to people.
Absolutely. Absolutely.
There's also liberalized deduction for educators to deduct their expenses. There is a $500 energy credit for creating greater home energy efficiency. There's a whole series of things that apply. The other one that I don't want to miss is that there is if you don't itemize your deductions. So in 2017, they raised the standard deduction for a married couple to $24,000, which meant a lot of people no longer itemized their deductions, which effectively meant that you no longer got a tax deduction for your charitable contributions. Didn't mean you shouldn't do them, because again, you should always do things with the idea that it's something you want to do and it's the right thing to do in the first place. But the eliminated the deduction made it a little bit more, potentially a little bit more expensive for those that make the contribution. So while it's not huge, the act provides that you can deduct even if you don't itemize $300 of charitable contributions, but now they've raised that to $600. So that's a little bit of an added benefit. it's around the margins. Like, I don't think anybody's going to get crazily excited about that kind of stuff,
Right.
but it's existed. So that's the stuff on the federal side, Dale.
Alan, but that I know a number of, I do a lot of work with nonprofits that many of them have been hurt by that. That, you know, many, it really has had a significant impact on nonprofits.
It absolutely did, particularly on the lower, you know, those lower level, those that kind of that group funding stuff,
Yeah.
where people might have, you know, done it because, again, it only cost them 70 cents on the dollar to do it, and now they might have cut it back as a result of it. So this might help a little bit, but probably not all that significant. And the big donors, the ones that are giving, you know, tens of thousands of dollars, or, you know, even thousands of dollars, they probably are looking to itemize their deductions anyways, and hopefully we'll still be getting the benefit.
Right. Okay. So that's the federal side. Now,
Yeah.
and you've been very active on the state side. So
Yeah. So the biggest change, and I'm really proud of this one, Dale, and Tony and his organization, along with others in the state, were so instrumental in helping get this passed. It's called the Business Alternative Income Tax. So just by way of background, and again, this applies to businesses. So if you're not a business owner, you probably can, you know, take a couple of minutes and get a cup of coffee here. But if you're a business owner, this is one that really is a good one for you. So again, by way of background, when the Tax Cut and Jobs Act came out in 2017, one of the things that it did, it severely limited the state and local tax deduction that you were claiming before to $10,000. And if you live in New Jersey, there's a good chance between income taxes on your personal income, along with your property taxes, you're going to hit that $10,000 limit pretty quickly. And there's been a lot of talk about that, and, you know, a lot of push to move that back. And we could talk about that later if you're inclined to do that, Dale.
yeah.
But what it did was it meant that business owners no longer could probably deduct the income taxes they pay on their business profits. And that seems to be a little bit of an unusual result, because businesses always get to deduct their ordinary and necessary business expenses, at least most of their ordinary business expenses. And just because they were formed as a flow-through entity, meaning that the individual owners, and most entrepreneurial companies are formed this way, the business owners pay the tax on their personal tax return, it eliminated their ability to deduct their tax, which effectively raised the effective rate on their New Jersey taxes by about a third, depending upon their tax rate. So what we did was we went to New Jersey. We said, what if you modernize the tax system in New Jersey, and instead of taxing the individual owner on their business income, allow the corporation or the LLC or the partnership to pay the tax instead, which would create a federal deduction at the state level. I'm sorry, at the federal level for the taxes being paid. New Jersey listened to us. It was a little bit of advocacy that went on. And at the end of the day, they passed a bill. I might add, it had 7 votes in the New Jersey Assembly and the Senate combined. There were 7 votes, and it received 0, not a single no vote along the way. Wow. And then on January 13th of 2020, the governor signed the bill that enacted this particular legislation, which in effect, not getting too technical, basically has the business paying the taxes at the at the corporate level, at the business level, resulting in a federal tax deduction, and effect reducing your federal taxable income and saving you taxes on the federal side. So I'm going to just throw out round numbers: $1 million in taxable income at the federal level, starting out, you know, $1 million in taxable income. The New Jersey bait tax would be roughly somewhere around, again, simple math, I'm going to use 10%, about $100,000, which would mean that you would only report $900,000 to the federal government, effectively giving you, depending upon your tax bracket, about a 30% savings. So if $100,000 deduction and you're in the 30% tax bracket, that'll save you $30,000 in federal taxes.
Right.
Here's really 2 cool things that I want to point out here. Number one is that New Jersey collected through the month of January, collected $1.2 billion in bait tax. So clearly this is something that's popular. If you just apply a 20% effective tax rate to that, that means that New Jersey business owners will save about $240 million in federal tax.
Wow.
Just to put that in context, Dale, the millionaire's tax, which everybody is up in arms about, and I'm supportive of being up in arms about the millionaire's tax, is going to cost millionaires, the people making $1 million and above, about $300 million. And here we have a program that will save New Jersey business owners probably in excess of that amount of time. I think that is something to celebrate.
That is, but let me make it very clear. So this was really your and SobelCo's idea to really push this, right? I mean, you and you're modest, and so you really helped to change the tax code for the benefit of taxpayers.
And I want to say, Dale, it took a better part of a year, closer to 2 years, to get it done. I mean, so it was a while.
And it was the last good thing that happened in 2020 in January.
Very true.
But
Dale, you're right. Listen. I'm not so sure I'm the only one who had this idea. In fact, I know I'm not. But I did take the initiative to write, people, including Tony, and was able to get some initial support around this, and then was involved in writing the legislation, which was a great experience for me. It's a little frustrating at times, and I'm dealing with a little bit of frustration now. But overall, it really was a great effort. And yes, I'm proud of the efforts that I've taken, but it really did take a village to get this thing done. And I will say, Dale, I think the lesson there really is that there are a ton of ideas that are out there. There are so many business owners and people that have ideas and professionals. And so many of them say, I have this idea, but I'm not going to do anything about it. The lesson that I learned is that when you have a good idea, do something about it. You can make a difference. And like I said, I'm very proud of what we've been able to accomplish as a result of that.
Yeah, well, that's fantastic. Now we have a question, and I'm going to give Tony a chance, and I'm sure his members may have some questions. Could you elaborate on what LLCs are eligible to do this? Does it have to be a multiple owner LLC? Does it apply to all pass-through entities?
That's a great question. So the simple answer is you have to have at least more than one member for this BATE tax to be eligible. It does not apply to sole proprietorships or single member LLCs. So in the crafting of the legislation, we pushed to try to get sole proprietors and single member LLCs in the mix. And this is one of those areas that we gave in on. And here's why. It's relatively easy. It's not perfect, but it's relatively easy to be able to change your business solution to be able to qualify. So let me give you 2 examples. If you're a sole proprietor, Schedule C sole proprietor, one who reports your income on a Schedule C on your tax return, just form yourselves as an LLC and elect to be an S corporation. If you do that, then you will qualify. Or elect to be treated as a partnership and admit one other member to your LLC, like your spouse or your child or somebody, and give them a very nominal interest. Once you have more than one member, you'll be able to do that. So the correct is single member LLCs and sole proprietorships cannot avail themselves of the BATE benefits, but with a little bit of planning, I think you can do the things to make yourself eligible.
Wonderful. Before I ask Tony, I want to mention Ron West, who's chair of our accounting department, had invited a number of professors and students. So I'm hoping we have a number of students because they need to. I love connecting the real world with the academic. And so, Tony, did you want to ask any questions from CIA&J's perspective?
Well, I don't know if, Alan, you're going to cover it, but now that there's talk about going back to remove the SALT cap, you think, what are your thoughts on that? Does it impact what just happened in New Jersey? Well,
yeah, so great question, Tony. And I said I think I said at the outset that there's a great deal of political momentum to try to repeal the elimination of the SALT deduction, meaning bring back the SALT deduction. I think it's one of those things that, even Republican legislators that are generally, that were supportive of the Tax Cut and Jobs Act that eliminated it in states like New Jersey or Massachusetts, are behind this. And so this is one area where I think you could get compromise and unity, bipartisan, that's the word I'm thinking of, bipartisan support to be able to do. So I'll talk about the future of what's going to happen in tax under the Biden administration a little bit later, but I do think that the SALT deduction probably is one of those things that can come back. So then the question becomes, well, is it still worthwhile to do the New Jersey? Will this eliminate the benefits in New Jersey? And I don't think that it eliminates the benefits of it, because most of you on this call that are business owners know that when you filed your income tax return, you were probably subject to the alternative minimum tax, which basically eliminates the ability to get the advantage of a state and local tax deduction. The reason that you went into the alt min was because you had high state and local taxes. And so the BAIT, basically, because it's a deduction in calculating your business income, would not be one of those items that would trigger the alternative minimum tax. So I think that this BAIT is still going to be beneficial, even if we, even if the SALT deduction comes back into play. In addition to which, it reduces your self-employment tax. So those of us that are formed as partnerships or as sole proprietors wouldn't work, but as partnerships, all of our income is subject to self-employment tax. And we pay, if we're not over the FICA limit, the Social Security limit of roughly $145,000 now, if we're not over that, we're paying almost 15% tax on that income. And if we are over that amount of money, we're paying roughly 3% tax on that income. So this deduction, this BAIT deduction, will reduce that. So you'll save 3% on that alone. So I do think, Tony, that this will survive that. In fact, the idea that I had about this initiated because I was trying to find workarounds for the alternative minimum tax initially, and it kind of just cascaded when the SALT tax, and there was enough political interest in this thing to make it go. So yeah, I think BAIT will survive and is actually the right way to approach taxes in general for businesses.
Good. And I want to, if you have any questions, and we got the one question in the Q&A, be sure to put your questions in the chat or the Q&A so we can ask. And so let me ask this early on, Alan. And I always am curious because I'm a futurist and policymaker. And one of the things that frustrates me is, you have one group that says, reduce taxes on millionaires, and others says increase taxes on millionaires. I'm saying, why don't we reduce taxes on job creators? On those people. I mean, I don't care if you're making $1 billion and you don't create jobs, tax the heck out of them. But if you're creating jobs, is there a way to do that? Or since you put, one program in, maybe we can get something in like that. And nobody seems to talk about that. What's your thought about that?
Well, so Dale, you're spot on. That's the beauty of this business alternative income tax, because it does help business owners and job creators. And if we want to have a vibrant economy, we need to do it because people are employed and they're making more money and they're doing better, and they can then pay people who then have their own greater earnings and be able to, stimulate the economy through that. So I do believe strongly in creating that. Things that can be done, and I have to say that there have been programs at the federal level that have definitely spurred, job creation. One item is what's called bonus depreciation. So in the past, if you went out and you bought a piece of equipment, you'd write that off over 7 years. Okay, you get a 20% deduction the first year, and that was helpful. That was that's good to be able to write off your equipment. But with bonus depreciation, you get to write off all in 1 year. So that was one thing to spur business owners to go out there and make investments in things. New Jersey decouples from the federal government when it comes to that element of taxes. So New Jersey, one of the things New Jersey could do is they could allow bonus depreciation like the feds do, which would further, help business owners in New Jersey reduce their tax profile, which would then in turn hopefully use that money to be able to reinvest in their businesses, create more jobs, and spur growth that way. The millionaires tax, again, so here's the problem with the millionaires tax. It's not that you raise the tax basically a penny or 1.5 cents on people that are making between $1 million and $4 million. I mean, think about that, right? At $4 million, if there's a 2% increase, their tax is going to go up by 80 grand. I mean, I'm not suggesting that that's not a significant amount of money, but if you're making $4 million, $80,000 is probably not going to move the needle on you. But here's the dilemma, and I know Tony appreciates this tremendously because he and I have had conversations about this. There's a tipping point. It's not the extra 2%. It's the 9% that got you there in the first place. And wealthy people in particular have the ability to just move. They're not so tied to the local element of New Jersey. Many of them have homes in Florida, for example, where they pay no tax. So it's just easy. All they have to do is spend, 181 days or 185 days in Florida or out of New Jersey and have a residence down there, and they'll claim themselves not as residents, and New Jersey will lose all that revenue. So it is a balancing act. Other things New Jersey can be doing, are these incentive programs. Tony's probably a lot more knowledgeable than I am on that at this particular point in time. But we have these incentive programs, Grow New Jersey, and they went under a whole lot of scrutiny. Some of it warranted. I mean, there are people out there who definitely abused these programs. And, I know Tony and I agree on this as well. And I'm sure you, Dale, as well. That is, we shouldn't put up with people that are, scamming the systems. But at the same time, we should not be punishing those people or demonizing people that are legitimately taking care of these programs and that are keeping their businesses in New Jersey or growing their businesses in New Jersey or locating their businesses to New Jersey as a way of growing the economy here. So I'm grateful that New Jersey's come out with some new programs, and I hear good things about them. But we have to make sure that this doesn't become the next demonization of business owners. They're really, for the most part, doing the right thing. Most business owners I know, most entrepreneurs that I know, are not greedy, bad people. They're motivated by growing their business, not just for their own personal well-being, but for the people that they create, particularly family business owners. They really do view their businesses as families.
Well, and Alan, that's what I was going to say. I mean, I was a state official. I worked for Deloitte Consulting for a number of years. And, family businesses treat employees better than any other sector of society. I would put it up against government employees, nonprofit employees, big corporations. Once you've been a part of the family for a number of years and you stay there, they treat you very, very well. And people don't understand it. And that's been my frustration. We're almost evangelical at Rothman Institute to say, hey, this is the backbone of America. We need to not try to put them as second tier, but really first tier. And so we really have been. So let's talking about that PPP. Is it forgivable? Is it not forgivable? What's the story about that?
Well, I'm not sure if you meant, is it taxable or not taxable, but forgivable
yeah,
or
taxable or
yeah, the forgiveness is whether it's taxable or not. So this is also good news for business owners, those that applied for PPP loans and those that will apply for and get forgiveness on it. The legislation was originally passed by Congress, said that the forgiveness of the loan would not be includable in income. Their intention was very clear not to make this taxable. Treasury and the IRS came back and came out with a ruling last year that said, even though it's not taxable, the expenses associated with it therefore will not be deductible, which in effect was making it taxable, right? And here's the real sad part about it. Let's assume you got a $100,000 forgiveness loan. The way that you got the loan and the way that you can get it forgivable is you had to spend the money on payroll. So you went ahead and you spend $100,000 on payroll. Your business is suffering. You go and you spend $100,000 on payroll. And then all of a sudden the government comes at you and says it's not deductible. And so therefore you're going to basically have to pay taxes on that income. You spent $100,000 and now you got to come up with $20,000 in taxes, and your business is suffering, and your restaurant is about to go out of business. So it was a problem. So fortunately, Congress heard that. They were not happy with it. I know that across the board they felt that the IRS overreached their boundaries, but the IRS, in fairness to them, was following precedent and the rules. And so what happened in November was December, I think it was actually. No, it was November. Congress passed a law that basically said you can deduct the expenses associated with PPP, which then took us to New Jersey and other states, because the question would be, would the states now follow suit? And the good news, and Tony, I don't know if the governor actually has signed it yet, but I do know that New Jersey, that the governor has given indications that they will follow the feds on this. So PPP forgiveness will not be taxable for federal or state purposes, which is great for those businesses that are suffering.
So let's talk about, because this hour goes by so quickly, but the future. We have a Biden administration. What do you anticipate going forward?
So the truth is, I really don't know.
Right.
But I'll tell you what I kind of think, and these are just my own personal beliefs. I don't think you're going to see any tax legislation, significant tax legislation this year. I just think that there are too many other priorities that need to be taken. And let me preface this by saying, with a Congress, with a Senate basically split 50-50, and although the vice president has the tie-breaking vote, the rules of the Senate, you kind of have to have more, you need to have more than 50 people or 51 people in order to get legislation passed, unless you go through this process. I think it's called reconciliation. And, that's not always easy to do. And it requires, it means you can't make legislation permanent. You have to have a sunset date and so on and so forth. So first of all, we have a divided Congress. Second of all, we have priorities. And right now, I think the priority of the administration, and I think the priority of the government in general, is to get us through this COVID mess. And so the idea that we're even going to debate or even have discussions on taxes, to me, is going to be, it's going to take some time for that to happen. So at best, we're looking towards the end of the year, right? And then, we have other priorities like legislation that's going to, help build our infrastructure. And then again, you're going to have to get some moderate Democrats to be, to look towards increases or changes in the tax law. And I think you're going to have some difficulty in doing that. So my personal belief is you're not going to see a whole lot of legislation taking place in 2021 on the tax side. I've made predictions before and I'm usually wrong. So, take that for what it's worth. But I think it's going to be difficult, which means now you get to 2022. And guess what happens in 2022? It's an election year.
Right.
And so you're now in an election year, and chances are you're not going to get too many people, particularly those that are moderates, to want to be voting for tax increases.
Right.
So at best, we're looking at 2023, and then you're into lame ducks, periods and stuff like that. So I think it's going to be difficult, but nonetheless, I do think that there are some priorities that the Biden administration would like to put in place, that they have, to increase taxes. Some of them are not so terrible, if you ask me. Again, for example, raising the tax rate from 37% to 39.6%, which is one of the things that I've been talking about, to me is not the end of the world. Particularly those that are making a lot of money. That's putting it back to where it was in the Obama administration, putting it back to where it was in the Clinton administration, and in both of those administrations, we had economic growth. So maybe not as robust as people would like, but we had economic growth. It wasn't a drag to the economy. But you don't want to raise taxes in a recession. And we have a lot of unemployment. We're clearly in a recession because of COVID, and this is not the time to be doing it, in my opinion. There is the raising of the corporate tax rate from 21%, which Biden has talked about, to bringing it to 28%. That's the C corporation rate. Probably is a little bit more harmful, but what I've learned with corporations is they learn how to work around the system anyways. So, the impact is probably not as great as it might be if you didn't have creative people working in those corporations on figuring out ways to reduce it. A lot of people felt going from 35% to 21% was too extreme in the first place. There's one tax that concerns me, Dale. And so one of the things the Biden administration wants to do is they want to increase the Social Security tax for people making over $400,000 a year. And they want them paying, right now it's capped, anything over $140,000, you don't pay the 6.2% tax on that. They want to tax that now at over $400,000 a year as a way of helping, secure the Social Security system. I think that's a very burdensome tax when you think about it. Right, somebody making $500,000 would have to pay another $7,000 in tax. And what I'm not clear on is the employer may not end up having to match that, which means that you're paying almost like $15,000 in tax. If you're self-employed, you're paying another $15,000 in tax on that incremental revenue. I think that would be very, very difficult for business owners, and I think that's something that we need to keep an eye on and make sure that we advocate against pretty well. So those are the big items that I see, and we'll see if I'm right or wrong.
Well, that's wonderful. I have a few more questions, but Tony, did you want to give any legislative update or anything? What's going on in New Jersey?
I was actually going to go back
Okay.
to the PPP thing again, because this is a question that I'm struggling with, and I get a lot of members who ask, and I say, talk to your banker or your accountant or lawyer. But so if I got $100,000 PPP loan, last year in 2020. It's not considered income, right? It's a loan. It's going to be forgiven if I paid it salaries, real estate, your leases, rent. And then you said that you could deduct expenses. So what's your thought when, and they usually call it the April surprise, right? When these 2020 tax returns are going to come in, do you see the states, the federal government really losing a lot of money because a lot of this stuff was tax exempt?
I don't think they're going to lose. So the answer is, I don't think they're going to lose money because of the forgiveness. It wouldn't have been, if all things were equal, right? They would have, and there was no PPP, they would have lost money because they wouldn't have had the revenues, essentially, the income to support that. So I think this is there's no harm, no foul here, right? In a basketball vernacular, right? That nobody's harmed as a result of, no, the government, I should say, is not harmed as a result of this, and business owners are not harmed. In fact, business owners, now just get a benefit from it. So I don't see it being impactful to the Treasury because they wouldn't have these revenues from the forgiveness in the first place. This wasn't like, somebody went out and had excess sales and were exempting those sales from tax. This is something very, very different.
Yeah, and then the other thing I was going to mention, Dale, and I thought it was kind of interesting, but I guess according to the New Jersey Department of Treasury, they're flush with money. I guess the thing that surprised me is the sales tax revenues were up, but also the inheritance tax went up, and then the realty fees, right? So a lot of selling and buying in real estate, but I was surprised to hear, Alan, that the inheritance tax was higher than expected. So I guess a lot of people are estate planning or, I don't have any thoughts on that, but.
So Tony, that's a really, I wasn't aware the inheritance tax went up. The only reason I could think that is happening is because all these deaths from COVID.
That's a good point.
But New Jersey does not have an estate tax anymore, or at least technically the estate tax rate is 0. And the inheritance tax comes about when you give money, when a decedent gives money or bequests money to somebody that is not their blood relative. So a distant relative or an in-law or something like that, or a friend. So I'm a little surprised because most people I know give money to their children, which would not be subject to New Jersey inheritance tax, or their spouses or things of that nature. It just must be an anomaly because there are more deaths in New Jersey. I don't think it has anything necessarily to do with the laws themselves.
Okay.
So New Jersey has this 2-tiered system. They have the inheritance tax and they have the estate tax, and it's this inheritance tax that captures some unwitting people about of having to pay some tax in there. The big, the article that I read had about a 4% increase in revenues collected through January. The big portion of it was this business alternative income tax. Again, that represented $1.2 billion. I think the sales tax revenues being up is a result of some changes in tax law that occurred a couple of years ago under the Wayfair case. So in the past, if you didn't have physical nexus in New Jersey, you did not have to pay sales tax to New Jersey for goods that were shipped into New Jersey. So if I bought on, it's not a good example to use Amazon, but if I bought on Amazon, I didn't have to pay sales tax on that. What happens now is Amazon has to collect sales tax under this Wayfair case. And I think that's just coming into place where more and more companies that are selling online are now having to collect from their customers and then remit those sales taxes to New Jersey. So I think that's what's causing some of the increases there.
Yeah, and then the last thing I was going to say, Dale, is next Tuesday, the governor delivers his budget address for FY22. So all the business groups are wondering, what is he going to come out with? And we all think we'd be surprised if there are going to be any increased taxes in this budget, but we'll see next Tuesday.
And Debbie Schaefer. So Debbie Schaefer, who spoke at our Family Business of the Year Award in 2019 and has been a client of mine. She runs the appliances, Mrs. G TV and appliances, and she was fighting that because you didn't have to pay taxes to the internet. So that you have an appliance store. If you buy it online, you don't pay taxes. You buy it in the store, you have to pay taxes, and so that change really helped a lot of this going forward. And so. So as we're looking at, the CARES Act Act and payroll taxes and other things. You want to say some more about that?
Before I do, Dale, and not to answer your question, one other thing came to mind as it relates to New Jersey and the governor's budget and taxes. So another anomaly has occurred here because of COVID, and that is people that typically would work in New York City or other places are now working at home.
Right.
And there is a tax case that's going on in the Supreme Court. I think it's Massachusetts actually, where Massachusetts wants to continue to tax people from, like, for example, New Hampshire that are working at home in New Hampshire, but historically would have worked in in Massachusetts. New Jersey, I'm pretty sure New Jersey came out and said, we're going to still, New York has been very adamant that New York is still going to tax the people, even though they're working in New Jersey now. They're basically saying that it's, for the convenience of the the employee, and therefore New York is going to still look for the revenue. New Jersey typically gives a credit for the taxes you paid in New York. And so New Jersey's come out and said that they're not necessarily looking to change that. So that's a leakage that we have in New Jersey on the ability to collect revenues. But, and here's the interesting thing, New Jersey filed an amicus brief on that case in support of allowing for New Jersey to tax those people. I think that if New Jersey does that, there is going to be a tremendous influx of revenue. And what we should be talking to New Jersey about is reducing taxes at that point in time, stabilizing our economy, or dedicating that additional money towards paying down some of our debt, whatever it may be. But that might be a windfall that New Jersey sees, much like the Wayfair created a windfall.
And Alan, that's the challenge with government, is that, so here you are, a small business, you've been closed by government. You really don't get much support, but now government wants to get support for the pandemic, right? They don't want to have to pay their dues because of the pandemic, but they're making businesses pay their dues. And this is not Democrat or Republican. This is just really, and just don't understand the impact. And we feel it every day with our clients.
Yeah, and we have to be very careful here, what I'm about to say, because there are people who are really struggling, like a lot of business, small business owners and restaurant owners and those in the hospitality and the travel industries. But what I am incredibly surprised about is how resilient so many businesses are in general. So there are probably in the neighborhood of, I'm making this number up, I don't know statistically, but 10 to 20% of the businesses that are struggling. But there are 70 to 80% of businesses that are actually holding their own and doing well. We can't lose sight of those that are struggling, because they are, that is a big part of the impact. But I am amazed at how resilient we are. And look at the markets, look at the stock market and things like that. I don't even understand it half the time. But nonetheless, yeah, we do need to make sure that we take care of our business owners.
So you are, one of the things that we've said too is that extra $600 that employees got, it would have been wonderful if they could pay it through the businesses, because, a lot of people aren't coming back to work because of that $600. Is there any, on an individual basis? So is there, if I was unemployed and I was collecting that, is there any forgiveness with that, or how do we report that in the tax system?
Yeah, and first of all, I apologize. I'm getting a signal here that my internet connection is a little unstable. So if you're seeing it on your end, I do apologize for that. My dog started barking, but stopped barking, but now I don't have internet connection well. But no, unemployment, unfortunately, is still taxable. There's no relief that's being provided on that. I haven't even necessarily heard about that. And that is a trap for the wary. So if you get unemployment tax, generally speaking, unless you elect to do so, they're not going to be withholding taxes. And so now you collect it, come April 15th, you're going to be picking up taxable income, and that is going to be subject to tax. So I think there's going to be a big April surprise in that regard, Dale, for many, many people that have not adequately withheld on those taxes. I hope that they set aside, money when they were doing it, but those people that are trying to put food on their table, or trying to get ends meet or pay rent, chances are they were using every dollar, and they're going to have an issue come April. Maybe the government will give them some time to pay it back, or give them some relief on a payment schedule, but there's no provisions to forgive that at this stage of the game.
So one of the, one of the things is that a lot of family businesses are looking to sell. They were, prior to the pandemic, many financial experts were saying that was one of the best times to sell because the cost of capital was low and businesses were doing well. And then we have the pandemic. And so many are looking to sell. So what tax advice do you have to people if they're looking to sell their business that they've had for a number of years? And, what would you say to a family business in that situation?
Yeah. Okay, I think I'm here. Can you see? Can you hear me?
Yeah, you're fine. You're fine.
Okay, good. It must be on my end or something. But first of all, again, I go back to the adage that I said, never let the economic tail wag, the tax tail wag the economic dog. So the first thing that my advice is make sure your company is strong to begin with. Get it ready to be sold by having, good accounting records, making sure that, you don't have a lot of extravagant expenses running your business. Tighten up the things so that you can drive the greatest value possible. But beyond that, I think the biggest thing is in the negotiation is make sure you negotiate the best structure for the sale of your business. Ideally, you'd want to sell the stock in your corporation because that's going to result in the lowest tax that you possibly could have. But buyers typically don't want to buy stock. They want to buy assets because it's tax advantageous for them to do so. So think about how in your negotiation you want to position yourself for the sale of stock, agree to a sale of business, but negotiate some adjustment for that to make up the difference between what it would cost you on an asset sale versus a stock sale. And the reason that occurs is because in an asset sale, some of the assets that you sell are going to be subject to ordinary tax treatment as opposed to long-term capital gain. For example, if you bought a piece of equipment and you fully depreciated it, when you sell that piece of equipment, you pay tax at ordinary tax rates. So negotiate an allocation of the purchase price that reduces the amount that's allocated to property or equipment, or the buyer grosses the purchase price up to make you whole on that. That would be one element to reduce your tax. The other thing you might want to do is consider, from an estate planning point of view, consider transferring some of the assets to other generations within your business and take advantage of the currently generous tax exemptions that exist out there from an estate tax perspective. So structuring your ownership might make an awful lot of make a good sense prior to sale to reduce the exposure. Because the other thing is you might be able to get lower valuations on your business before you enter into a sales process than you get when you start creating an auction and things of that nature. So valuations are supposed to be reflective of the value of your business, but we know there's a range, right, of what a business is worth. So you might be able to transfer some of that wealth, ahead of time. Those are probably the two most significant things that, as you're going about your business, but be wary. Buyers of businesses are generally more experienced than sellers because buyers have done it, as part of their business models. Sellers usually do it once in the course of the cycle of their business. It's rare that unless you get serial entrepreneurs, it's rare that you find people that sell their businesses multiple times.
Right. Wonderful. So you and I have something in common, which is rare that you came up with an idea, and I came up with this idea of entrepreneur zones. We were crazy enough to convince the governor and legislature to pass it, and so now we're starting a working group on entrepreneur zones. And the reason that I came up with the idea is because of tax credits. Is that the whole politics around the tax credits? One person was aligned with $1 billion of tax credits, so the governor was saying, let's get rid of those tax credits completely. I said, well, don't do that. Why don't we give tax credits to people who invest in businesses in the poorest communities in the country? Because when you talk about, especially African-American business, they're talking about 40% of them closing. So a lot of the businesses in urban communities have really, really been struggling. So we're hoping to do that. What have you looked at tax credits, or what's kind of your thinking as an expert on this, on state tax credits?
First of all, I applaud your effort, Dale, and it's so needed and it's so important. And I believe very strongly that we need to provide people with the incentives to take the risk to go into underserved communities and underrepresented communities and invest in those communities. I'm not suggesting there's not a business reason to do that outside of the credits. There needs to be a business reason. The credit is not going to make up the difference. But if we can make it a little bit more palatable to reduce the risk level, we're going to get better traction on that. The new incentive programs that are out there includes, for example, incentives for food deserts. So you talk about the inner city areas where there's no supermarkets, and people have to drive and get out into other areas to get food. That is an example of a tax credit that would make it more palatable for people to invest in areas where they are taking on greater risk. Mm-hmm. Here's one of the things that I think that's on the table. Well, this is not on the state side of things, but on the federal side, which I think we have to keep an eye on and understand. So under the past legislation, there was something called opportunity zones, right, where if you sold something for a capital gain, you could defer the gain on that and exclude a portion of the gain on that if you invest in an opportunity zone. One of the things that the Biden administration is targeting is the elimination of opportunity zones, because they think it favors the wealthy. And if you think about, the idea is to bring some tax justice, if you will, or, that's one of the things that's on their plate. I don't know what's going to happen because, Cory Booker, who is probably one would argue is a progressive senator, he was one of the creators of that particular program. So, I don't know whether, Biden will get the support to eliminate that, because it does encourage people to invest, even if it benefits the wealthy. It encourages people to invest in opportunity zones. So. And
that's one of the, we've actually studied a lot of that, and there are actually some opportunity zones that work. There's some that accelerate gentrification. So it's not a be all. And so we're hoping that entrepreneur zones will replace opportunity zones federally. So we're talking to people about that, to invest in businesses in the community that create jobs. And it's all about, and that's why I'm so passionate about providing tax incentives for people that create jobs. That should be the focus.
So Dale,
4 minutes. So Tony, do you have any final things?
I was actually going to ask you, when does your work group start to meet?
Well, that's a good question. I don't even know exactly. I know a couple of people, Jill Johnson and some others, are on it. So hopefully at the end of this month or early in March. And so you're going to be an advisor on that. I recommended you for the group, but we'll see. But it's an important thing.
Yeah, no, I agree, and I'm glad that you're on it, and I look forward to it. Actually, the EDA opened up a process where, there's no fewer than, I think, 10 programs in the New Jersey Economic Recovery Act. So they're looking for comments on how to make the application process easier. It's definitely enhanced. The scrutiny is going to be there, but I think in total it ranges between 11 and 14 billion in tax credits over a 7-year period. So it's comprehensive for sure. But
and Tim Sullivan, gets it for small businesses. He's the CEO of the New Jersey Economic Development Authority. We've had him as a guest. And so we're almost at one. Alan, I have to ask you, who's that on the wall behind you? Who's that?
That is Mr. DUI himself, Bruce Springsteen. That is on the wall behind me. Hey, Dale, can I just make one comment about, we hear a lot about the need to create equity and wealth in this country, and it's growing in large proportions. And I don't believe it's about wealth transfer. I think it's about wealth creation, not wealth creation for the wealthy, but wealth creation for the middle class and the lower middle class. And institutionally, we're going to have some people that are always going to be left behind, but we can do a better job of helping people, middle class and lower middle class people, raise their standard of living, which ultimately grow the economy overall. And that's why your entrepreneurial zones or your empowerment zones are so important. We in New Jersey in particular, we have the ability to create a vibrant business economy by helping grow wealth within those middle class communities. And that's what I would like to see us focusing on, and not taking away from the wealthy just to give it to the not wealthy. Let's create wealth for the wealthy in the way that everybody in this country should be afforded the opportunity of the American dream.
And I'll end it with this. So I'm part of a planning committee. On May 30th, we're going to have a remembrance in Tulsa, Oklahoma. In 1921, there was a section called Greenwood, which became the wealthiest Black community in the country during segregation. And literally those families had 7 of the families had planes, and it was all built on entrepreneurship. So the idea of the entrepreneur zone is built around this, is that those communities can be very, very strong if we're supportive of entrepreneurship. And so that's our passion. Alan, this has been wonderful as always. I have a book full of notes. You are a star. Tony, as always, some great insights. I want to thank all of our visitors and guests for listening in, and we will see you next week. But thank you all. Take care. Have a great weekend.
Thanks, everybody.
Thank you, everybody.
Thanks, Alan.
Thanks.
Dale.
Bye. Bye.